Today, we're going to be looking at dollar cost averaging versus lump sum investing. And when I say investing, I mean investing in the stock market. These are two kind of primary methods for, let's say you've come into some money, have a large cash balance, and want to get that invested into growth type vehicles, meaning the stock market. How best to do that. And we're not going to necessarily advocate for one over the other. They both have advantages and disadvantages. So there's merit to both for sure. And sometimes we'll recommend one over the other for sure for our clients. But it's very case specific and just really depends on the situation of the investor. But I want to discuss the pros and cons of each. And then, obviously you can make that determination or speak with your advisor about how you want to handle the situation if you find yourself in it. But dollars cost average in a nutshell, is investing methodically a certain dollar amount over a period of time into the market versus just dumping it all in at once, the lump sum investment. And they both have merits. And there are other, obviously, methods for how you might invest cash. To me, they're probably not as advisable. I mean, it can be a little bit more chaotic where you say, well, maybe it's just on a whim whenever I feel like it. That could be one method. Wouldn't necessarily suggest that. Another might be, really trying to time the perfect in and out or the perfect time to put it in. That can be dangerous as well. Wouldn't necessarily advise that simply because markets really cannot consistently be timed. We've seen this time and time again where it's just really impossible to consistently do that. So I would probably stay away from that. But anyway, let's kind of get into it. And so, as with anything in life, knowing what we're supposed to do and what we actually do can be two separate things. This is true for health, relationships, careers, finances. So when it comes to investing, it's well known that properly diversifying and staying invested are really the best ways to achieve, your long-term goals. But this is often easier said than done, especially when market and economic outlooks are uncertain, as they have been for quite some time. But fortunately, there are investment methods for managing these emotions that come from market volatility, which we're going to discuss today. And so, what should investors know about how to kind of stick with an investment plan through years and decades? What could help with that? And so, knowing when and how to invest in the stock market can be challenging, especially if you suddenly come into a large sum of cash through maybe an annual bonus, maybe the sale of a business, a large inheritance. In the long run, investing properly can turn savings into wealth. But in the short run, market volatility can really derail even the most steadfast investors, as we've seen time and time again, unfortunately. But so this is where dollar cost averaging can really help. So with dollar cost averaging, what you're doing is regularly investing a set amount on a pre-planned schedule, a set dollar amount, regardless of the ups and downs in the market. So this reduces the temptation to follow and then react to every market move or trying to time the market, which we know doesn't really work. So, and if you already make regular contributions, automatic contributions to say your 401k plan, some type of retirement plan at work, then technically you're already using dollar cost averaging. So most investors, especially if you work for a corporation, are already doing this to an extent. So whether these investments occur monthly, quarterly, annually, turns out to matter much less than simply sticking to the plan. So it's more importantly is, are you disciplined? Are you sticking with the cadence? Is more important than the exact whether it's quarterly, monthly, what have you. So the opposite, investing all at once, known as lump sum investing, this is, how and how your portfolio performs in the short run is very much determined by how the market performs immediately after the investment. In the case of lump sum investing, this can be seen in this chart. I'll pull this up. So this shows the hypothetical returns between these two methods, lump sum and dollar cost averaging, beginning in 2000. So this is a long period of time. So investing $100,000 in the S&P would have lost almost immediately due to the dot-com crash. Again, I realize you could cherry pick these times. This is just an example, because if you picked another starting point and the market went nowhere but up after that, your experience is the exact opposite. So we know that this can work both ways, obviously. But this, in this scenario, this would have recovered over the next several years until the housing crash, or the great financial crisis, whatever you want to call it. So finally, the value of this investment would have recovered in 2013, when the S&P returned to all-time highs, and then benefited from the long bull market that followed. But the chart also shows the hypothetical returns of a dollar cost averaging approach, in which you would have split up the $100,000 into monthly investments over the full period. And again, this is a rather extreme example given the length of time, because this probably would look at a much shorter time frame for dollar cost averaging into the market, call it maybe 6 months to a year. So again, this is very extreme. But it does serve to highlight some of the key facts here between the two scenarios. So dollar cost averaging on a monthly schedule in this scenario would have avoided the market drawdowns early in the period, when the portfolio would have mostly been held in cash, remaining relatively flat through the mid 2010s, let's call it. And so there's an inflection after this when the lump sum portfolio catches up and outperforms due to the strong bull market. So both methods had their benefits and time to shine over the past 2.5 decades. And again, so much of this depends on when you're doing this, the environment we're in, whether we're at the start of a bear market, or we're at the start of a bull market, or kind of somewhere in the middle. It really is going to affect the outcome, obviously. Now, that being said, the reality is that the market goes up more than it goes down. That's the truth. So you have to take that into consideration, I think, as well. There's a couple other charts I wanted to just touch on real quick. So there's two kind of scenarios. Again, we're just trying to show the differences between two kind of extremes. But in this particular one, you have a scenario one where we're comparing, again, dollar cost averaging and lump sum investing. But this is at the beginning of 2022, which, if you remember, was a pretty bad year just in general. I mean, stocks and bonds were down. It was a tough time. But in that scenario, dollar cost averaging would have, even though both scenarios were down, you were negative return, which is not fun. The dollar cost averaging approach yielded a much better return because of the fact that the market was going down, as you can see in the chart here, and you are stair-stepping up, investing $12,000 a month. And your average price per share is lower than it would have been with a lump sum investment had you just dumped it all in, and the market proceeded to go down. So it's obvious in this scenario, in hindsight, that yes, dollar cost averaging would have been the better way to go. But that could have easily reversed. So if you had the start of an up year, call it 2021, for example, the exact opposite. So again, so much of this is dependent on the timing, but we'll talk about some other factors as well. This is just another chart to show, again, kind of looking back over a long period of time through various market environments. And so this is scenario number 2. This time we're taking a 20-year look. Again, extreme because I don't think that you're going to dollar cost average in necessarily over a 20-year period, unless it is in a retirement type account where it's really taken out of a paycheck and done more methodically and consistently over time. That absolutely would be the case for a lot of working people. But this is assuming that there was a large chunk of cash to begin with. So over this period of time, it's pretty obvious that the lump sum investment, given the amount of time to compound all through the ups and downs of the market, was a much better way to go because you had that money working for you up front as opposed to stair stepping in over time. So in this scenario, you have an annualized return of 7% in the dollar cost averaging approach versus 10% in the lump sum investment approach, which is a pretty staggering outperformance over time. And the longer you spread these time frames out, the more you're going to see an average type of return. And this is the S&P 500 ETF investment. And so the longer we spread this out, of course, you neutralize the massive ups and downs, the volatility a little bit of the market, and so you're going to see much more of an averaged annualized return, which is exactly what you're seeing here over this 20-year period. Historically, the market has returned somewhere between 9-10% over a long period of time, and that's indicated here. So, the takeaway here is less about how to maximize returns necessarily than how to stay invested through years and decades. Dollar cost averaging can help reduce risk in situations where, markets fall sharply, especially early on. Say you're coming up close to retirement and you've got a large sum, maybe a 401k rollover or something like that. Or it hasn't been invested, something like that. However, lump sum investing tends to outperform dollar cost averaging in the long run, since historically markets have steadily risen over time. So I think the reality is over most periods, and I think over all 20-year rolling periods, the market has never been down. So, that it holds true that if you have a long runway, the reality is that it just purely from a performance standpoint, the lump sum investment has a good chance of outperforming the dollar cost methodology simply because of the nature of markets rising over time and going up more than they go down. It's just that simple. But there's a huge psychological component to that as well, where you just may not be geared for that. You may feel much more comfortable and help you sleep at night to kind of put that in over a period of time and not have so much at risk in the market all at once. And that's totally fine. As long as you're staying with a disciplined approach and getting invested sooner rather than later. But going back to this whole, dollar cost averaging versus lump sum investing. So we talked about the fact that historically markets have steadily risen over time. So, this is analogous to comparing a 100% stock portfolio to a properly diversified one that holds, a balanced mix of stocks, bonds, and maybe some other asset classes. The 100% stock portfolio might outperform over long periods. I would expect it would, especially during strong bull markets like today's. But it also experiences much sharper pullbacks. There's no free lunch there. So the diversified portfolio, on the other hand, you got a mix of stocks, bonds, maybe some other asset classes, will experience steadier growth and more muted declines. And so it makes it easier for investors to stay level headed. And so you can kind of think about that, when you're thinking about dollar cost averaging versus lump sum, kind of the more diversified approach, the dollar cost averaging versus the all stock, kind of high octane lump sum investing. So, I think this is especially relevant today with the market, still with all the kind of pullbacks we've had recently, it's still fairly near all-time highs. So the truth of the matter is that markets are always uncertain. Whether it's the upcoming presidential election, geopolitical conflicts, just the direction of interest rates are all top of mind in the economy. Investors may worry that the market could pull back just after they invest. And of course, that could happen. On the flip side, maybe it doesn't happen and the market just continues to go up, 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 up. But it's important to keep in mind that just because the market's near a current peak, it doesn't necessarily mean it's due for a pullback. I think sometimes we're a little nonchalant in saying that. It's a little cliche, due for a pullback. And I say it of myself all the time. But by definition, markets achieve many new all-time highs as they rise during bull markets. That has to be the case. So while there's significant uncertainty this year, obviously due to rates, inflation, the Fed, the S&P, the S&P has already experienced 24 new all-time highs just this year. It's pretty crazy. So this includes a sharp rally in May after a pretty major slump in April. And then obviously we saw, we experienced the pullbacks in August, and we've had many ups and downs, obviously. And ironically, it can be psychologically difficult to invest both when the market is rising and when it's falling. I mean, it seems a little, again, it is ironic because you seem to think, well, it's harder to invest when the market's going up, 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 up. But we've seen the opposite is also true. It's equally hard, if maybe not even harder, to invest when the market is just going down, down, down. Even though you probably, that is the better time to invest, psychologically it can make it very hard. So there's this fear that the market might be at its peak in the first case when markets are at all-time high, and then it might fall further in the second scenario. So there's really no, it's easy to say, well, when the market falls or when we're in a down market, that's when I'll put the money in. That's really hard to do because psychologically you're thinking, man, I don't want to be the sucker that catches a falling knife and I throw all my money in and it wasn't done falling and I continue to ride that down. It's just as hard psychologically. In other words, it doesn't matter if the market's going up or down. It's hard to pull the trigger without a kind of methodical approach sometimes. Or just saying, you know what, I'm going to let the chips fall and I'm going to invest it all right now. I've got a long runway. So whether dollar cost averaging or lump sum investing makes more sense, I think depends on the individual investor and their maybe emotional and psychological ability to handle the risk, and also your time horizon. I think it goes without saying that time horizon is huge. If you're young and you happen to come into an inheritance or for whatever reason have a large amount of cash in your 20s or 30s, investing the lump sum, that's a whole lot different psychologically than being in 60 and getting ready for retirement in a few years. That's a very different mindset, I think, in a lot of cases, and a very different stage of life. So all these things have to be taken into consideration. There's no right or wrong answer necessarily here. But whether you choose to dollar cost average or invest all at once, getting into the market sooner has historically been better than waiting for this magical pullback. We hear that all the time. Well, I'll wait for it to pull back a bit since we've had a run here, and then I'll invest it. But let's take a look at this chart. So waiting for a better time to buy or trying to buy the dip tends to backfire more often than not. Since the market tends to rise over time, as we've discussed, and can rebound, unexpectedly, even the worst timing is often better than being out of the market. Now, that can sound counterintuitive, but it's true. So for example, an investor waiting for a 5% pullback before investing would, on average, have waited 291 days. Even though 5% or worse pullbacks do occur periodically, the fact that the market rises over time means that there are often higher lows, i.e., the next dip is higher than before. And so historically, markets have gained a whopping 13% during these periods, a figure which includes the pullback itself. And so just as a diversified portfolio can help reduce overall risk and volatility, so can dollar cost averaging when it comes to investing over time. So dollar cost averaging may not be the mathematically optimal way to invest, just from a pure returns standpoint, since lump sum investing does tend to outperform over long periods of time. But it can help investors to stay focused on the long run without worrying about every market event or trying to time the market perfectly. Uh, you know, and as is always, I think just so much of this is very specific to your situation and your financial plan. Seek the guidance of a financial advisor if you don't have one, and that's really the best way to determine what approach is going to work for your specific goals. So it's not a one size fits all, but I hope that this sheds a little light on kind of these two really primary methods of dealing with kind of a cash infusion and how to get that invested. So the bottom line is, although every situation is different, dollar cost averaging and lump sum investing are both ways to invest cash. Obviously, really history shows that getting invested sooner rather than later is really the most important way to achieve those long-term goals. So really appreciate you guys tuning in today, and I hope this helps to shed a little light on dollar cost averaging versus lump sum investing. Thanks so much, guys. Hope you enjoyed this, and have a good one.